ahead is going to be somewhat ranged, and therefore it's a very good time to look at what will be the dominant themes of 2017 as well. What will be the global cues, since despite domestic impulses, it will be the global cues that will decide how Indian markets will perform, and that's what we're going to get you. We have a special series running, The World Economy in 2017, and we are getting you a series of guests on that. We are now playing to you the word we got from Stephen Descantis. He is the equity strategist, equity stock picker at Jefferies. In an exclusive conversation with me, he says strong dollar is better for the global economy, and he expects the strength of the dollar to continue at least in early 2017. Listen in.
For our firm viewpoint and my viewpoint personally, I think the dollar does have a ways to go here. We've got higher interest rates, the Fed's raising rates. Even now they're talking about potentially raising rates 3 times next year. You've had higher inflation, you have better growth, and I do think that the dollar is going to continue to appreciate here.
Well, in that case, is it likely that most smart money will prefer the developed markets, prefer the United States equities to probably emerging market equities?
You know, I think we actually are a little bit more positive on some of the emerging markets where they've been able to take their, they took their medicine and now they're starting to look better and they're starting to rebound. Now, remember also the dollar's appreciating due to better growth here in the U.S., whereas at the start of the year, the dollar was appreciating because people were thinking that we were slipping into a global recession. I don't think the recession situation is on the table right now, and better growth in the U.S. actually is going to give you a better dollar, but I think it's a better backdrop for the overall global economy.
Okay, so you don't fear then that U.S. growth will be kind of snatching growth from other economies. There is a fear that President Trump's policies would be growing the U.S. at the expense of, say, China or Mexico or other emerging markets. Could that be the case, that U.S. growth doesn't necessarily mean EM growth?
I think the big thing for U.S. growth for our firm is that we're thinking that, the U.S. consumer with jobs and higher wages will start to do a little bit more spending, and that'll help propel a little bit of the growth rate here in the U.S. Plus, we have very easy comparisons on the manufacturing side. So manufacturing gets a little bit better. I think, we still really haven't heard and seen the policies for President-elect Trump yet. And so we really need to see the meat on the bones. And then, remember, he also has to get this approved. A lot of his policies have to get approved. And so I think, it's going to be a really interesting early start to 2017 when Trump does take office. So again, we'll see how the policies get adopted here.
You bet. It's going to be interesting. We've seen a fairly good run for metals, metals and crude, largely commodities. Normally, they don't do well when the dollar does well, but the last 1 or 2 months has been has been bullish for crude and metals as well. Would that theme continue in 2017? Good for metals and crude?
First of all, the firm forecast is for that crude oil prices hit somewhere in the low 60s. So I think the forecast for 2017 is that oil prices do move higher. On the commodity side, I mean, we've seen a pretty big run right now for a lot of the metal-based, the metals and all the mining stocks have done really well. Since really the February low here in the U.S., I think they're destined for a bit of a pause here. Also, we haven't really talked about a stronger dollar, but a stronger dollar does hurt commodity prices in the end. And so I think, for metals specifically, I mean, personally, I think for materials, we've been a little bit more bearish. I've been a little bit more bearish on the case.
Okay. Well, actually, you sound pretty confident about the U.S. consumer consuming more and more manufacturing happening. This sounds a little like 2003-04, when, Alan Greenspan said that he would remove accommodation at a modest pace. So although we had interest rate hikes, we also saw U.S. growth and with it global growth. Can this be the happy picture of 2017?
I think you get a reacceleration of U.S. GDP. I mean, we've been stuck in the 2% range for a while. I think if you do get corporate tax cuts, if you get consumer tax cuts, I think that sets up for a little better growth. I wouldn't get euphoric about growth rates. I think the Jefferies forecast for 2017 is 2.7% growth for the U.S. It's better, but it's not fantastic. It's not like 2003, 2004. And also, remember, 2003, 2004, we were coming out of a recession and also from a bear market. And really, we're like 8 years into this recovery, and now we're all starting to see a real acceleration of growth. I think you get a little bit more growth, mainly due to the consumer feeling a little bit better, but I still don't think it's going to be as robust as we saw, again, in 03, 04.